The bad news is that the second part of the other part of the economy, you have the housing market, you have the labor market. These are the two big ones. You can just think of, from yourself. And if my house is okay, or it doesn't depreciate in value, you're okay. If it appreciates, you feel a little more wealthy and you'll spend a little more. But even more important is how you feel about your job security. So if you got a secure job, then you feel better and you feel that you can, spend more. But if both of these start to deteriorate, then it's, not a good thing. And we are only in a situation now where the good news is that the labor market still is strong, but the housing market doesn't look very strong, and actually looks very, very bad in the US. And we see house prices starting to decline. We see that it's frozen solid in terms of the number of new homes sold. We see mortgage applications are down in the gutter. We see that the affordability index is down in the gutter, and all these things is a heavy anchor on the economy. This is something that is weighing in. It doesn't turn it over and roll it over immediately, but it's something that is weighing in and making people spend less. So, and again, nothing goes in a straight line. We have had an upturn now since the COVID low, where we just induced a lot of liquidity into it, and still haven't seen the housing market actually bouncing back for real after that. So yes, we're seeing prices, but we don't see the activity. We need to see activity in the housing market. That's what drives the sound economy as well. So as we don't see that, then there is this, the anchor holding us back, which I think is going to turn us over to roll the economy over. So these are the good things. The ugly one. So now this was the good, the bad, and now the ugly one. And the ugly one is definitely the size of this bubble. And the size of this bubble, if I'm right, then when we start to see the deterioration of things, it's going to be very, very destructive, because people will be. We saw it also into the April bottom here. I mean, people panic immediately, and things are being sold off really, really quick, and you get 20% down like in no time. And that's because everything is so overvalued at this point that when some kind of volatility comes in, if the economy rolls over, people start to lose their jobs, which I think it will happen, then you're going to see this kind of sell-off. And that's going to be very, very quick. If you look at some of the main indices that if you track the housing market, and especially the wider housing market, because what's important about the housing market is that it also drives a lot of other activities around the housing. So, when people have to upgrade their homes or whatever they do, then it, it drives a lot of activities. And if you look at the one that is called the NAHB housing index, which is a broader index for single home family homes, you'll actually see that is actually plummeting, and it's actually been plummeting for quite some time, and it's now seemingly moving even further down, and that is not a good sign. So yes, we may see that prices have not started to outright decline just yet, because people are not selling their homes in droves just yet. They are capable of maintaining the home, but if the moment that things start to shift, well, then people will not be able to do so, and that's the problem here. If they get forced to start selling their homes, which could happen, well, then because of the economic slowdown, well, then you could see that this can actually just exacerbate the size of this crisis here. So and also there are other indices that shows that we may have seen a very big top. It doesn't roll over immediately, and if you look at there's a Philadelphia housing market index as well. If you look at that, seems like to me it's made a very big top. It did the same in 2005, and it took some time before you saw then the crisis setting in, a year and a half, 2 years later. But this one is also an important factor that I'm saying that, well, I think we've seen a top. I think it's going to go down from here. It may not be felt immediately. It's like the frog sitting in water that's getting hotter and hotter. And I think at some point you'll see people starting to jump out because they simply cannot afford the high rates that we see right now. That's why also, if you look at the credit card delinquency rates and so on, they move up. And this can take a while. I mean, this is the process. It takes a while. And then when people are starting to jump and they are forced to sell their homes, that's the moment when you see that the full effect starts to unfold. So we're not there yet. And that's also what we see. The maybe there where this deadweight anchor is keeping things down a bit somewhat, but I think it's going to be the one that actually pulls us over completely at some point.
And if we look at the leading indicators in the housing market, one could tell that maybe anything that is about mortgage applications might also be giving some signals or information about that, but they have ticked up recently and permits have kind of stabilized. So is it that bad right now? Are we maybe is the worst already over, especially if considering that the Fed might cut rates in the second quarter of 2025?
Well, you say they're ticked up, but if you look at it at the affordability and you look at the mortgage rate applications also, they are down the gutter still. So yes, so when you're all the way down the gutter and we say they tick up, that's a part of the normal. You can see adjustments or the ups and downs, I would say. I'm not sure I can see why things would be moving becoming better here, because they actually, as I look at it, things, and you see that there is a slowdown in manufacturers around the world also, and you can also see that the ECB, for instance, and other central banks are trying to stimulate the economy at this point here. So I don't think that people like to think that this is the worst as it gets, and now it starts to become better from here. I actually see that I'm expecting to see it getting worse from here, because we have the indicators that tells us that normally when we see yield inversions and the likes, and we see the housing market declining, well, then we should be expecting also to see something happening in the labor market. So I have to turn it around and say I actually don't think things are getting better here. I think things are going to get worse from here, and that is what eventually also will put the top in the stock market whenever we see that final top. We're still working on that.
Mm-hmm. But you've also mentioned in the past, if I'm not mistaken, the fact that low affordability doesn't always automatically cause a crash. It also has to do with a combination of consistent, persistent job losses, and that would then force to get the price down, or not?
I'm not sure I've said exactly that, but yeah, of course that we will need to see some kind of you'll call it probably a trigger. That's what people always say. We need a trigger. We need something that sets us off. I actually think that this is it's an evolution that is developing. You can just look at the U.S. consumers. What is it that right now tells us that the U.S. consumer is feeling better off? Not a lot. And if you look at the consumer sentiment, not a lot there tells us that things are getting better at this point here. Actually, it seems that it's getting worse. So I know people would like to say that now it's getting better from where we are, but we haven't seen the full ramifications or the full consequences of the rates that we have seen. People have been able to hang in there for just until now, but it seems like things are rolling over slowly, and you're starting to see some oil has been breaking down also, which is an indication that there is an activity slowdown in transportation. Also, there start to be indication of slowdown in transportation around. Just most recently, we saw something also a little more positive here, but again, these can be it's always which way are you looking at the trend, or are you looking at a small bounce when we see something of a new development, right? So I don't think we can all just pick out the latest number and say this is actually the new trend. It can be just a small bounce before we head lower. But as I said, I also think we have seen a small reacceleration in the coincident indicators for me, which is the real economy, and that can last. We actually did the same thing in 2007, right into the moment when they rolled over. And to me, we have a crazy overvaluation of so many different assets, and we have still the anchor that is keeping us down. I expect worse things to come, but I still don't think we are at the end where things will develop.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth.